Welcome to the final recording of 2025. We asked some questions from the subscriber base, and not surprisingly, most of the questions relate to either Rudy, what is happening in the market, and the second question, of course, relates a lot to the quality and the quality growth stocks in the market as part of my research into all weather companies, and neither question should surprise. Let's start with the first question. What is happening in the market? The short answer is the perfect storm. A lot of people look at the market in much more simplistic ways, which leads to very simplistic explanations and definitions of what constitutes a bear market. I am more of a little bit more of an intelligent approach, and I believe that bear markets come along much more frequently than investors casually account for. It doesn't have to be defined by a 20% drawdown, and it definitely doesn't have to be confined to what happens at the index level only. If I would say, for example, that cannabis stocks have been in a multi-year bear market, then nobody would dispute that, but nobody would care either because, I mean, who owns cannabis stocks? But for example, the energy market has been in a persistent bear market since 2022, and that process is still not finished, and that means that you, as an investor, you still have to be a little bit more careful with your exposures to oil and gas stocks, for example. Anyway, long story short, we are at the moment experiencing a bear market for anything that's trading on a higher than average PE ratio in the market, above average valuations. And that includes the likes of the quality stocks that we have in the market, but it also includes some of the larger and smaller growth stocks we have. Because in the good times, they're all trading on higher multiples and higher valuations. And at the moment, if you agree with me that it's a bear market, the focus is very much to the downside. I get questions from what would be a great entry point, how low can they go? In the bear market, those questions are probably answered to the downside. Two different points of view here. If you are in it, that is literally bad luck. I don't think too many people have anticipated this from happening. That means you have to weather it out. Of course, you can always sell, but you risk that you sell at a point that is much closer to the bottom than it is to the upside. In particular, since this bear market has already been going for a number of months. How long can it go on for? Big question. My preferred comparison is the similar time in 2016 when the general setup wasn't in many ways was not that different. We had more than a year the so-called expensive defensives, defining anything and everything that was happening in the market. Very frustrated fund managers, I remember, they would constantly go to the press and complain about how long it was going. In the last 4 or 5 months of the year, the portfolio rotation kicked in, better growth prospects, Trump presidency, return of inflation, you name it, and it lasted into the new year until things became more balanced and normalized. It sounds very friendly, portfolio adjustments, broadening of the market momentum, etc. But in practice, of course, it can be quite brutal and violent. That's not the only thing that's happening. I mean, we saw the early signs of portfolio rotation probably this year as early as July, August. Subsequently, we got into a big scare. All of a sudden, share markets were too expensive. We got the same narratives returning that we also saw in late 2024 and which were debunked after that, but they returned this time around, so we got a little bit of a scare. That combined also with quite a large number, to my surprise, of people getting really worked up and starting to make comparisons with late 2029, with early 2000s. Um, I've seen advisors advising their clientele that technology stocks were now going to fall by up to 80% over the next 2 years, which obviously is a reference to what happened in 2000, 2002. I don't think that any of those forecasts will prove correct, but clearly it has had an impact on the market. Next thing you knew is that the whole scare moved on to outside of technology, but specifically on AI, on markets in general. Bond markets have moved, which in particular is not very beneficial for stocks that are trading on above average valuations. And then, of course, in Australia, we saw quite a brutal reversal in interest rate forecasts since the RBA was supposedly still going to cut by 2 times in 2026. And that has now shifted to at least one hike and maybe potentially two, even though a lot of people still think they'll be on pause for a long time. The market and part of the economists community is thinking that February might be the first meeting for a hike already, just to make sure that inflation doesn't run away from us. And that reversal is translating in a market that essentially is not doing anything anymore outside of the occasional rally in mining stocks. And then even that often has problems in duration, everything. Anyway, at the index level, you would think that this market there's nothing to complain about, but underneath it, there's a lot of bloodletting happening. And no surprise, a lot of people are throwing in the towel. The appetite has gone away. Overall activity across the industry on social media, we see it as well at FNArena. It's getting to a very low point. Clearly, investors are thinking there really is very little benefits to be had of being active or even attentive in this market. It probably struggles into year end, I think. And let's hope, fingers crossed, that we are closer to the end than to the middle of this process. If 2016 is a comparison, is a guide, then we should be getting towards the end of this process, and we might by mid-late January we might be looking at more momentum for companies like WiseTech, Zero, CSL, ResMed, Car Group, REA, you name it. In the meantime, unfortunately, any reason is good enough to sell more. And even if there's no reason, then usually the day will still record minor losses. Minor losses don't seem like much, but if it happens every day, ultimately it accumulates, of course. So yes, the burden is there, but we should all realize, hopefully, that bear markets, yes, they can be very brutal if you're in it, but if you have cash and you have patience, they also often offer opportunity. And I think opportunity is what's opening up here. Clearly, there are still risks out there. Can we have some bad scenarios unfolding in 2026? Yes, of course. I mean, that's called life. But history and current insights, I would argue, are more in favor of a positive skew for next year. And in particular, when share prices get pared back so much. I mean, 30% is nothing. Some of those share price falls are exceeding that. And that's quite a lot, even if you would take into account that maybe some of those share prices might be a little bit hot under the collar at some point. Going down by 30-40% is quite a lot. That is also signified by a lot of the price targets that currently remain above those stocks, and they can sometimes be 100% higher. Even if you think those price targets will have to be reset, chances that they are being reset simply to current prices or even below it, I wouldn't. I'm not a betting man, but if I were, I would bet against that. Now, specifically to those criticisms, and in particular with AI, I think both AI and both share market valuations are quite unusual, and they obviously put the they raise a lot of questions, but also amongst how people actually assess markets and how they look at markets. And I can confidently say that outside of fear and a general sense of being uncomfortable, my eye openers have been by how simplistic many people look at the market, and also how much they still reason from the past into the future. One of the easiest to identify anomalies in today's market is that the market valuations at the index level should be higher than they were 10 years ago or so, because the composition has changed of indices. But there's a lot of people who haven't caught up with that. So I wouldn't necessarily argue that markets are dirt cheap or markets are fair value. Valuations are higher than in the past, but there's equally an argument to be made that that should not necessarily be a reason for concern. On the assumption that we don't see any economic calamities next year, we don't see any calamities from the bond market, and those profit growth forecasts prove not out of sync with reality. Question mark that will be answered throughout the year ahead. Now, coming specifically to quality and growth stocks, I still remain of the view that while every company, of course, at all times has a risk profile, and in particular with AI, there's now a lot of narratives going around. I think a lot of those narratives, they remind me a lot about when Amazon came to Australia and all the retailers got sold down, and that ultimately proved way too soon and actually misguided, in particular up until now, and that's quite a number of years. The other, which was much more closer to my experience, of course, is the advent of the likes of Ozempic and the likes, which very briefly put pressure on, in particular, Fisher & Paykel Healthcare and ResMed. That too proved very premature, way too early, and up until now, and that's also again now quite a number of years. If we can take the ResMed experience as an example, it got sold down quite heavily, but has subsequently recovered by 100%. And in recent times, for the reasons I just pointed out, that has deflated a little bit more, but not as much as many of the other companies. That gives us a little bit of an idea in how narratives can potentially create opportunities, because I believe, and that's will be something I will be writing about next year and probably make some videos as well. I believe that as markets change and financial markets are changing, I believe that we will become even more narratives driven than we were in the past. And that means we will have on one side the risks for our stocks being impacted, which is now happening, for example, also with ResMed again, with REA, with Car Group, Seek, and others, Zero, for example. And on the other hand, it will obviously also create opportunity, as we saw in the recovery of the ResMed share price, once it becomes clear to enough people that the narratives were misguided. Now, specifically to my research, I know that people would like me to point out my personal favorites and all of that, but it's a bit like I'm the father of so many children in that research, and I love them all as I should. Often, whether you prefer Cochlear over ResMed or vice versa, that's a personal preference, and that is also the reason why I share my research with subscribers with all those stocks, because sometimes when I look at adding more shares, I'm not looking at the ones I like most because I probably already own them. And that's not necessarily the case for you. So my best advice is to use this period in just reading up, go through the website, read maybe my writings, read what the experts are saying about, and just try to assess which of those risks, which of those stocks you are more comfortable with. And I would definitely, not just outside of the point of view of diversification, but also out of the point of view that bear markets do create opportunity. And I do believe that there's now a lot of opportunity in this market, both in small caps, mid caps, and in large caps. Some of my favorite stocks, and you know them, they have been sold down quite a lot from here onwards. And I could potentially go through all of them, and that is what some of you have asked. But that might be a little bit over the top here. Maybe a more interesting addition to make here is that the portfolio itself, in hindsight, mostly too early, because we definitely underestimated the duration, the swiftness, and the brutality of this bear market kicking in. And that means that you jump on share prices thinking like, "Ooh, this is already quite low," and then they simply go much lower. We should never underestimate that when you have low liquidity bear market conditions, which we have now in Australia, there's always some nefarious people out there who will try to maximize their benefit out of those situations by specifically targeting uh, particular share prices and try to get them as low as possible. And that's, for example, what you see with stocks like a Technology One, like a Promedicus, that I believe are specifically being targeted. And clearly, what happens is they start looking very badly on price charts. They start looking badly on the technicals, and before you know it, you get a self-fulfilling prophecy. Um, those two companies, for example, I still maintain that they remain amongst the highest quality, most reliable, most secure growth companies we have on the ASX. That's not always represented in the share price. At the moment, it's not, but ultimately it will. And that's even what history shows you, and what the future, I'm sure, will show us as well. A long-winded way in getting to the fact that the portfolio the all-weather model portfolio has used this period to put some of the cash into the market. We've still kept about 10% in cash. We have, for better or for worse, taken the view that at the very least, short term or otherwise, gold also has become more of a speculative asset here. So we've also reduced our exposure to gold a little bit. Whether that's going to be, we can always increase if at some point we believe that's the case. But good to remind us all that gold is not supposed to be a speculative asset in the portfolio. We treat it as an insurance. And of course, that's one of the assets we've done really well out of the past, not only this year, but of the past few years. But what we've done is we've added a few companies that, for whatever reason, were no longer represented in the portfolio, and we thought they looked attractive at lower share prices. And one of them is the one I mentioned, is Promedicus. We thought we were quite savvy in using the weakness, and share prices simply weakened more. So we were, in hindsight, too early. But again, we can always add more, and we can always wait what happens when exactly the bottom kicks in and the recovery starts. Two other stocks might be more interesting to highlight here. We have also added, and with a larger weighting than Promedicus, Saul Pattinson. And the reason for that is that we believe, apart from the share price weakness, we believe that Saul Pattinson is reinventing itself. It will become, we think, a much more diversified, a much stronger, much more powerful company in itself. Still savvy investors, but with much more cash and etc. and higher returns. And we think that the market hasn't generally caught up on that one yet. probably too blinded by coal prices and by building materials in the US. But we feel very comfortable with what essentially is a very high quality company and has been for a very long time on the stock exchange. And I don't remember exactly when, but at some point I did add it to my list of all weathers on the ASX. And we also added Sigma Healthcare. And again, we see a structural, very strong growth trajectory ahead for this company, which essentially again is a reinvention of itself because Chemist Warehouse is now the leading force in there, and not just the old Sigma. We, as people who know me, are very well aware, I usually wait 3 or 4 years before company IPOs, and I very seldom make an exception out of that. One of the exceptions I made in the past was Bepcor, and that proved very beneficial, at least in the first couple of years after listing. As you all know, I've abandoned Bepcor a long time ago, and so I've escaped 80 or 85% drawdown, whatever happened since. One of the other exceptions I believe I made was NextDC, and that also has proven very beneficial. I think we went four times over the share price, I think, over time. We still believe that a lot of the misconceptions out there about data centers being not profitable or in the eye of the bubble or whatever you want to call it, we still think that it's very misguided. And we also own Goodman Group, as most of you will know. Coming back to Sigma, we think we were just waiting because Sigma clearly immediately after that merger happened and Chemist Warehouse joined the listing. It has immediately been picked up by fund managers, high share price, etc., etc. We basically were just waiting for weakness to kick in. We haven't exactly bought in at the low point thus far, but we bought in at a lower point where it is now. The share price at the moment is slowly recovering in a market that otherwise sees more selling than buying. So we're a little bit lucky there in comparison to the other purchases we made. Long story short, the reason why I highlighted those companies, I think those I would definitely, if you're not on board yet, I would definitely have a good look at them and consider. Do your own research, of course, and otherwise, I don't know exactly how many companies are on my list today because I don't count them every day. But I would definitely have a look at my lists, considering different services where I recently made a few calls for 2026. On one service, I highlighted NextDC. Another service, I highlighted Zero. And another one, I highlighted Technology One. I could have highlighted pretty much all the stocks that are in my research on varying degrees. They're all cheap now. They look very much great value. In particular, since they all come down from so much from prices early in the year, and the wisest prediction I can make is that this too shall pass eventually. We just don't know exactly when just yet, but it will, and I think that's something we should bear in mind, irrespectively of how much appetite we have and how much attention we're now giving to the market. With that one, I'd like to wish you all a Merry Christmas, lots of festivities. Don't eat and drink too much. And we will continue doing our best and giving you the best service possible in 2026 and beyond.